Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. So thanks for joining us and for tuning in to our Real Estate 360 program today, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360 that comes to you daily Monday through Friday at 3 p.m., along with my co-host, Joe Kuchera and Lori Graymont. Be sure to tune in the other days for their segments with different topics and different guests. If you can't make the live show, you can catch our podcast on RE360radio.com, and you can catch my programs on TomWilsonProperties.com or on iTunes. You can also go to TomWilsonProperties.com and sign up for a weekly newsletter. That's a 1-minute snapshot, gives you the economics of what's going on in the country relative to real estate. Very nice read that digests. We have an economist who writes that for us, who is reading and tracking all the critical media and news information about what's going on in the country and summarize it for us for a nice 1-minute read, which is very nice to have that clipping service and report. Also, I have a report you can get, which is how to select the best product and best metro for investing in. So those are items that you can go to TomWilsonProperties.com and get at any time. We have with us our special guest, Richard Crouch, who is back with us again. We love having him here on the program, and Richard is a veteran Silicon Valley high-tech entrepreneur and top-producing real estate agent for Alon Pinnell Realtors. And Richard uses his high-tech background to help track the market and to share with us his insights about what's going on. So most of our programs, we like to give you as much fundamental information as we can that will allow you to make decisions and get educated in areas that will help you long-term. But periodically, we like to have Richard on and talk about what's going on with the marketplace and things that are a little bit more short-term, a little bit more market current to help you with your decisions on what you do about real estate. So today, we're going to cover a variety of subjects. We're going to talk about institutional investors and hedge funds. What are they doing? How are they affecting the marketplace? What direction are they headed? Also talk about short sales. How those stats line up and where are the predominant places where they're still a significant part of the marketplace, and how someone might qualify for a short sale if you are in that situation. We're going to talk about the baby boomers and the silver tsunami, or maybe silver heyday if you can figure out how to take advantage of it, and other related topics. So, Richard, great to have you back again on the program.
Thank you, Tom. Good to be here.
Good. Let's start off and talk a little bit about the institutional investors and what's going on. My gosh, we had during the crash and shortly thereafter, we had this situation where there was a number of people, or the majority of the population, who were losing homes through foreclosure or deciding to sell a home. Got to the point where we had only 33% of them, the stats showed, were able to qualify or interested in repurchasing a home. So therefore, we had all of these homes that needed someone other than an owner occupant to be in, and that was a situation for a while. And there certainly investors started stepping up, but mostly having to use cash because there wasn't much money for investors from institutional sources. And then all of a sudden, we have these institutional and hedge funds popping in, and I must admit that, I kind of sense that it might happen. 2 years ago when I got invited back with to go with Howard Blum and Sean O'Toole and Bruce Norris, we got to go back per the invitation of the chief economist of Fannie Mae to give a presentation to the 16 people there at Fannie and HUD on why and how how investors should play a larger role in absorbing this inventory. Well, I don't know how many people they listened to, but apparently they believe that was the case, and thus small investors didn't make out in the situation, but they sure turned on some large ones. So I think from a social standpoint, it's probably good because they absorbed a lot of this inventory that was sitting back there, not being foreclosed on. But so this has been going on for a year and a half. So Richard, let's start on that subject. What have you seen in the press, and what are you learning and hearing about what's going on with institutional investors and hedge funds?
Yeah, this is something that I think a lot of us don't usually think about, and so we've included it in this program because they do have a significant role and impact in the marketplace. Let's first of all maybe to give people a little bit of better understanding what an institutional investor is. It's a term really that defines an organization with large pool sums of money and invests those sums in securities, in real property, and other investment assets. So real estate is just one of many different financial investment assets, and that's where these companies come into play. Large institutional investors in the U.S. are buying real estate properties. New York Times recently reported the Blackstone Group recently bought 26,000 homes, and Colony Capital owns 10,000. Other firms are also adding to their portfolio. J.P. Morgan has initiated a fund to buy up to 5,000 homes, and Morgan Stanley has raised money to buy 10,000 homes. So
I think one thing that's really interesting about that is that the perception generally has been that hedge funds, which often don't have a recognizable face, are somewhat mysterious. We've heard about them buying up products and without quite understanding that whole process. And here we see a list of names that are household names. And so even institutions that we're familiar with have decided that real estate is indeed a great investment.
Yeah, and I think you want to put it in perspective, of course. And by that I mean that the number of homes being purchased by this type of investor, even if it's as many as 100,000, it pales in comparison to the 5 million homes projected to sell this year. Okay.
It's still a relatively small percent.
Right. These investors are concentrating in the hardest hit areas where they can find the best investment opportunities. And those areas have cited as being metro areas, of course, Atlanta, Los Angeles, Las Vegas, Miami, Phoenix, and Tampa, and New York. So fortunately for us here in the Bay Area, we're not one of those areas, so we don't see quite the impact.
Now, for those of us who are investors and are investing in other regions, and the reason that we generally, many of us who are investors do that is because it's very difficult to cash flow in an area that's as expensive as the one that we're in. That's because that it's very rents do not keep up in proportion with appreciating prices, and as that ratio gets poorer and poorer, it just gets to the point where it's impossible to cash flow. So where these funds are investing, they're not looking for speculative appreciation so much. They're looking primarily for cash flow. So they're going to metros and regions in metros where they can get lower priced homes. So that's why we don't see the effect here immediately in the Bay Area that very much. But they've certainly been in Sacramento, and they're in many of the major cities which are lower priced, which are major economic engines.
Yeah, and according to hedge fund manager Bruce Rose, Chief Executive Officer of Carrington Holding LLC is a fund that has managed over 25,000 rental homes. We just don't see the returns that are there adequate to incentivize us to continue to invest. So there's a dropping off of this interest. There's a lot of bluntly stupid money that jumped into the trade without any infrastructure, without any real capabilities, and kind of build it as you go mentality that we think is somewhat irresponsible. Ox-Ziff Capital Management Group, LLC, a $31 billion hedge fund, has stopped putting money into rental homes. The reason these firms are beginning to back away is they're not seeing the returns they'd hoped for. Bloomberg reports that Colony American Homes has found tenants for only 51% of their 10,000 homes that they bought, and American Residential Properties and Silver Bay Realty Trust, two additional investors, both reported losses in the quarter ending March 31st.
It's certainly... I'm sorry, go ahead.
No, I was going to say, they are in a business, and they have been very successful, and of course they're at a point where there's an ebb in the profitability of that business as we see it right at the moment.
Mm-hmm. Certainly when I first got a couple calls from hedge funds a year and a half ago, it was primarily folks who were younger people that were out of Wall Street arena, not in the real estate business, and they had been given the direction and orders to go ahead and buy properties. And I was told at that time they were looking for cap rates of 10, but they realized they might not get it, and probably a cap rate of 8 was okay. A cap rate, by the way, is the percent return on an investment in a year if there were no debt service on it. It's a way of measuring businesses, and no matter what kind of investment it is, it's a way of comparing them. But then as time has gone on, what we've seen is that in their thirst and competition with each other, we've seen cap rates go down to not only 8, but 7 and 6. And we're seeing and hearing about properties being bought at caps of only 5 or 6. And the strategy generally has been, for the majority of it, to hold on to those properties for some period of time and to package them and resell them at some point downstream at maybe a cap of 3.5 or 4. Well, originally when they started at cap of 10 and thought they'd resell it at 8, that sounded pretty good. But now I think what's happening is a lot of the people with a lot of the institutional money and the large private investors are saying, my gosh, if we're banking on having to sell this thing for a cap of 1.5, or I'm sorry, 3.5, 5 years downstream, maybe that's getting risky, and folks are starting to pull out. So we'll come back and chat about that a little bit more and move on to other topics. This is Tom Wilson with Real Estate 360. We have with us today special guest Richard Crouch, who's an entrepreneur with Silicon Valley High Tech and a real estate agent who's with us to talk to us about various topics here on Real Estate 360. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back to Real Estate 360. This is Tom Wilson, your host for the Wednesday edition. Remember, we're on every day of the week, Monday through Friday at 3 o'clock with my co-hosts, Joe Kuchera and Laurie Graymont. We have special guest in the studio today, Richard Crouch, who's a veteran Silicon Valley high-tech entrepreneur and a top-producing real estate agent for Alon Pinnell Realtors. And we're discussing the institutional investors in real estate, and we're going to move to short sales in just a second. But we were talking about how the institutional investors seem to be starting to slow down a little bit because some of them are concerned that maybe the returns aren't what they expected. So no surprise, I think, to a number of us that have been in the business a long time. We kind of thought it was maybe a bit optimistic and wondered at what point that's going to pull out. Now, whether that's going to be in 6 months or 2 years, the answer probably is going to vary by hedge fund or institutional investor. But it's unlikely, in my view, that this is going to keep on going forever. But for right now, it's still creating competition in the areas that investors like myself would like to continue buying. And I think, and basically, they're overpaying for many of these products. So, Richard, let's go talk about short sales a little bit.
Yeah, let's do that. I think, first of all, to understand maybe what's the big picture, because this is an area that we have all heard about and many of us experienced in one form or another, hopefully avoided. But certainly short sales have become the standard in the banking industry as opposed to foreclosures, because it does cost banks 3 times as much to foreclose than it does to do a short sale.
Well, that's a lot.
Yeah. But now there's a lot of government programs to help people who have short sales, and we'll talk about that in a minute. I think what most people may not realize is there's actually been a reduction in short sales as well as foreclosures. There was a lot of people that felt that the short sales would be going up instead of down. I think that's still true. I know that Wells Fargo Bank, for example, has implemented a program that getting it in place, a new program, because they've had multiple programs before that, to take the biggest wave that they still have in their portfolio successfully forward with a short sale is still to come. But short sales in the past year actually were down 15%, down 10% from the last quarter of 2012, and actually down 35 cents from the first quarter of 2012. So let's talk, where is this really the most relevant right now? Well, there's certain markets in this country that are still heavily impacted by foreclosure and short sale. Fortunately, here in the Bay Area, we're not one of those. But just to give you an idea, Rhode Island, 44% of properties are in that category. Connecticut, 42%.
And what category is that, Richard?
It's number of short sales are down. There are some markets that are impacted by this category. Here are the states with the highest percentage of short sales. Highest percentage of short sales. Again, Rhode Island, 44%. Connecticut, 42%. Massachusetts, 40%. Nevada, 29%, Florida, 26%, Ohio, 24%. The major markets with the highest percentage of short sales: Boston, 38%, Cleveland, 33%, Memphis, 32%, Las Vegas, 32%, and Detroit, 30%.
The latter ones, I think most people would guess, but some of those early ones, like Boston and so forth, what a surprise! And
I was totally shocked by Boston and Massachusetts being on the list, because you just don't expect that there, but it just tells you how pervasive the whole downturn and subprime collapse permeated just everywhere in this country and around the world, for that matter.
And even though the rate of foreclosures was not that high in some areas, there was this shadow inventory, if you will, of all these properties that have been delinquent and underwater that the banks weren't foreclosing on because they were trying to protect their balance sheets, which we would have done. If I were in that position, I would have done that too.
Right, exactly. So, but here, in terms of why the decrease in short sales, I think we could best explain that by talking about Silicon Valley, where we are here, and the Bay Area in general. And that is, there's a lot of confidence right now that even though you might be underwater, that you're going to be able to get out from under that. And that has dramatically reduced the number of people in that kind of a situation.
Let's come back on that note here right after the break and continue, wrap up a few more thoughts here on short sales. We have Richard Crouch with us today, veteran Silicon Valley high-tech entrepreneur and a real estate agent for Elan Pinnell Realtor, so talking to us about various topics, including short sales. This is Tom Wilson with Real Estate 360. We'll be back with you in just a couple of moments.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Well, welcome back to Real Estate 360. We have with us special guest Richard Crouch, who's a real estate agent for Alon Pinnell Realtors and has a high-tech career before that, which is helping us to analyze the market and what's going on. We were talking about before the break short sales. Let's continue a few more points on that, Richard.
Okay, so I think the news on short sales is that all of the banks and the U.S. government have put a lot of money invested into creating processes and timelines to take the sting out of the market that foreclosures and short sales have caused. So for specifically, people, I think, often really need to understand, well, how would I qualify for a short sale if I still felt that I could not get myself out of the house I'm in any time in the near future and I need to move on? So hardships that qualify. Let me give you Chase's list. Loss of employment, obviously one of the most obvious. Business failure. Damage to the property, could have been under the insured. Death of a spouse. Death of a non-wage earner, family member who was watching the seller's children. Severe illness. Inheritance. Inherited an underwater property.
Oh.
I had to clarify that. Relocation, divorce, military service, payment increase or mortgage adjustment, insurance or tax increase, legal separation, too much debt versus income, incarceration, or any combination of the above.
Wow.
So this is a very, very all-inclusive program that pretty much addresses everybody that is in a hardship.
You have to wonder, that long list, you got to wonder how many people out there assume that they wouldn't qualify or don't try, and they don't realize.
I think there's a lot of people in that category, and that's why the banks, I know Wells Fargo, for example, is very proactive in sending out very friendly notices with ideas on how we can help you in this situation. It comes across as benevolent and not in any way we're trying to collect money or anything of the sort.
And because of people's fear or apathy, both, I would guess that 90% of that mail goes in the trash without even being looked at.
Exactly,
right?
Exactly. So one quick summary point here, and that is that you have to realize that you have to be able to document and prove a hardship. If there's an income change, you need to document it with your pay stubs and tax returns. If it's an illness, medical records, etc. So that's the most important thing. But you have a lot of ways that you can get help if you're in that kind of a situation. Myself, I am actually a network agent for Wells Fargo Bank on short sales, but I've done Chase short sales, many for different banks. We can help people with that. If you need more help, I can point you to somebody in your area, or we'll be glad to try and help you if you're in the South Bay. There's a lot of help out there. Don't miss taking advantage of that.
And don't try doing it on your own.
That's right.
Right.
Don't try doing it on your own.
Because
you
have to navigate through a path and then do it exactly right, probably, or you get disqualified.
Absolutely.
Yep.
And
how can people reach you in case they're interested?
On the website, Richard and Candice, KANDIS.com. So www.richardandcandice.com. And you'll see a button there that talks about distressed properties and other helpful stuff on that website. We'd be glad to help out in any way we can.
So if you think there's any possibility that you might qualify, it's a great way to get some help here and getting out of the burden that you have. We have Richard Crouch with us today, agent with Alon Pinnell Realty, who's also got a technical background that's helping us look at various topics like short sales. This is Tom Wilson, Real Estate 360. We'll be back with you in just a moment.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back to Real Estate 360, where we have Richard Crouch with us in the studio today, who is an agent with Lompinell Realtor, and we are talking about short sales. So I think there's a couple other points you wanted to make there, Richard.
Yeah, I just wanted to add on timelines in terms of the process of getting an approved short sale before we move on to the next topic. FHA-backed mortgages, 45 to 60 days from the receipt of a complete offer from a buyer. Fannie and Freddie back 60 days for approval. The VA, 60 to 75 days for an approval. Portfolio owned, that means loans are owned by the banks, Chase, Wells Fargo, 45 to 60 days. And basically, the process is painless. It's pretty painless.
I'm sorry?
If you get some help with a realtor that has the experience. One thing you do have to do, of course, is you have to make sure that you do a good job of documenting everything, and eligibility that can be determined from that.
So if you've avoided going down that path because you heard that it took 9 months to get a response, or a year and or so, it was, but no longer.
That was in the days of the wild, wild west, and I'm happy to say it's not wild anymore. It's very much a proven practice, and it works.
Let's talk about next topic, which is pretty interesting, and everybody knows that boomers are moving through the demographic bubble. Oh, let's see. You want to talk about another topic?
Yeah,
first?
there's one little thing before we move into boomers, because that's important. But I found something here that I think all of us, especially here in the Bay Area, will find interesting, and I think very positive and very motivating. And this is looking at different ethnic groups in America and talking to them about their belief in home ownership. There's 4 questions basically that were asked. All groups surveyed are optimistic about the next generation of homeowners. And furthermore, a majority believe their children or future children will have a home of their own before the age that they did. Now, the number of people for which this was true within the Hispanic group, 78%, within African Americans, 74%, and within Caucasians, 56%.
So isn't it interesting that the previous white Caucasians that were a majority of what settled this country are now kind of pessimistic about their children's ability to have what they had, or better?
I think that the new demographic of this country, the people in those new immigration groups, they're really working hard and doing everything they can to be successful in this country, and that's good for this country.
And of course, our country is based upon immigration. They originally were predominantly from Europe. Now we're getting, I think, a broader immigration from all around the world.
Absolutely.
Even in spite of all the problems that we sometimes talk about on this program, it's still a pretty great place to be, and others recognize that maybe more than those of us who are blessed enough to be born here.
And of course, we don't want to overlook African Americans, which has been the longest standing minority demographic in this country, who are making a tremendous contribution. The next question was, or topic, each group views the home ownership as an overarching lifelong goal. In fact, home ownership is considered to be the biggest indicator of status by all groups. 78% Hispanics, African Americans 78%, Caucasians 65%. White picket fence prevails. Hispanics, they want it, 50%. African Americans, 59%. Caucasians, 55%. And we're going to need a bigger house. Hispanics, 63%. African Americans, 59%. Caucasians, 43%.
That's fascinating. Absolutely fascinating. Let's while we're talking about demographics, let's move on to the specifically boomers and what's happening with that part of the demographics and how that's going to affect real estate.
10,000 people a day are turning 65. It's the biggest demographic wave in the history of our country, 76 million people altogether. And about 30 million of them are in own real estate. And so what it means is, as time goes on, they're going to be selling that real estate. They're going to downsize. They want to move to where their children are. They want to be free of any debt and encumbrances, so they can travel and do all those things that we all want to do in retirement. I've had a personal experience myself with someone who is 58 years old, owns a lot of real estate investment property, but it's really not something she wants to have to handle in the future. Sadly, her husband did pass away, and we've been able to help her to take those assets, to sell them, and then convert the asset into lifetime income and other investments, and now she's free to enjoy the rest of her life. And there's a lot of people in that category that need help. And we're fortunate enough to be not only in real estate, but licensed in the financial services field as well. So we can kind of cover that whole process.
So it's so a lot of people, I think, may not realize that the real estate asset that they have maybe can produce as much either income or money as it might if you get professional help on how to leverage that and how to maximize that. Right?
That's right, exactly.
And it's so it's if someone thinks their home is worth a certain amount, maybe someone else, and like Wilson Investment Properties, could take a look at that and see how it could add value to it to maybe get some more out of it than what you initially thought, or to maybe help move it for you. If sometimes there's a product that just won't sell in even a hot market because it's not updated or has other problems with it, and there are those that can help take that property and add value to it to get the market that maybe is more predominant out in that area.
Yeah, I think the most important thing is not to be in limbo, not to know what to do. The unknown, that's what we can help with, eliminating the unknown.
Mm-hmm. Yep. So this is Tom Wilson with Real Estate 360. We are here today with Richard Crouch in the studio. He's a agent with Alon Pinnell Realty, top producer and a veteran Silicon Valley high-tech entrepreneur. Is using his technical background to help us decipher and analyze the market and see what's going on out there. We have some wrap-up information I think will be of interest to you. And we'll be back after the short break on KDOW 1220 AM, the Wall Street Business Network. We'll be right back after the break.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back to Real Estate 360. We have Richard Crouch with us today, talking about some popular subjects here on real estate in general, on institutional investors, what their impact is, short sales, and so and the demographics in the marketplace. So I think we see if we can give our listeners a little takeaway here on institutional investors. I think what we've learned is that they are not just the faceless hedge funds, but there's some major institutions with names that are household names that are also believe that real estate's a good investment. But they are, but now we're seeing that they are starting to overpay, and there are indications that maybe they're starting to slow down. I think that's would you say that's one of our takeaways from that?
Yep. And then, certainly here in the Bay Area that we're not as impacted by that.
Yep. And same thing on short sales. There are not as many around here in the Bay Area, but we know they're there, and there are many people, I think, that can probably benefit from it that don't realize they can.
Absolutely.
And if you have any question about it, you should get some professional help.
We are definitely here to help them.
Yep. And we'll get Richard's contact information here again in just a moment. And then the demographics. We know that we've got 10,000-a-day boomers that are turning age 65, and a lot of those folks are going to want to downsize, which means we're going to have quite a volume of turnover, but maybe different kind of real estate that they're going to want and that the country needs in the future. Less McMansions, more kinds of products that suit an active senior.
That's right. And, we also work with people that specialize in helping seniors transition, even those that are moving on to assisted living, for example. So we've got the whole solution with a team of people that I think people would appreciate having access to.
So, Richard, how can people get more information or reach out to you if they'd like to?
Okay, so once again, the website is richardandcandice, KANDIS.com, www.richardandcandice.com, at Alon Pinnell Realtors in Saratoga, California.
Good. And if you would like to put in some suggestions on topics or have questions for our program, please go to tomwilsonproperties.com. And also on that website, you can sign up for a weekly newsletter that gives you a snapshot of what's going on in economics in the country and how it affects real estate. And there's also a report there that you can request that is titled How to Choose the Best Metro and the Best Products in the U.S. for Investing in. So we would like to invite you back each week and every day of the week for different topics and different guests on Real Estate 360. Remember, Joe Kuchera and Laurie Graymont have other programs during the week, and we would look forward to having you back here the next time. So come and join us here on Real Estate 360 on each day of the week. And remember that the only thing that matters is what you do next, and don't wait too long to make decisions. You don't have to wait to have the best and optimum peak and valley. If something makes sense to you, go get some good advice and go ahead and make a move before you've missed a window of opportunity. Thanks for being with us. Tom Wilson, KDOW, the Wall Street Business Network.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.